Ladies and gentlemen, I just divested a good amount from my original positions to invest in bank stocks. What do I see and what should you take out of me doing this, guys? That's what we're going to be talking about today. I hope you're ready. Now, ladies and gentlemen, I hope you guys don't walk away from this video if you're not interested in banks or if banks are a little bit confusing to you, because I was in the same boat like a month ago. And what I ended up doing was I researched a lot. Actually, I bought a book. I'm still reading. I'm reading about it. This is a book that I just bought recently. I'm reading about. And so I'm learning about banking stocks as well. But I feel like at this point, I have enough knowledge to really look at the banking sector and say, wow, I think some of the stocks are undervalued. And so we're going to be talking about JP Morgan, Bank of America, and Cullen Bank. Cullen Bank is a bank from Texas. Bank of America and JP Morgan, you guys all should know. And I'm not going to be giving the same spiel that every other YouTuber gets. Okay, they all talk about dividends. They talk about how banks are, banks and they're the backbone of the economy. Yay. And they also talk about, guys, the last thing is always your PE ratio. Listen, I know you guys all know what a PE ratio is. I know you guys all know what a bank does. They take money from savers and give it out to borrowers. And so the point is, I'm not going to go through that simple, soft level explanation. I'm going to go a little bit in depth. I'm not going to go too in depth that you guys get confused, but I'm going to go in depth enough that you guys might understand the financial sector a little bit better and understand what kind of metrics I'm using, which, by the way, I haven't heard anybody talk about these metrics on YouTube. So guys, the first thing I want to do with you folks is look at the data and look at why I'm investing in two big bank stocks. Of course, we have Cullen, which is a regional bank in Texas, but first I want to talk about Bank of America and JP Morgan. What are people missing from the big bank game? And that's very important. So I want to turn you guys to an article from the Wall Street Journal. All right, so you guys got me on your top corner of your screen. We're on the Wall Street Journal. Title of the article is "The Biggest Three Banks Gobble Up 2.4 trillion in New Deposits Since the Crisis." And I want to tell you guys why this is so important. So in 2008, Bank of America, Wells Fargo, Citigroup, all these big banks, Lehman, okay, they were responsible for causing the market to crash into the recession. It's 100% their fault. And so the average person might be thinking, okay, so obviously they probably lost market share. They're obviously probably not going to be growing as much because people are realizing that these are bad banks that don't like to take care of their depositors or their clients. Well, it turns out that was 100% wrong. So let's look at the data, guys. Americans are parking more money with the biggest banks than ever before, cementing the firm's dominance of the financial industry less than a decade after the 2008 crisis. The three largest banks added more than $2.4 trillion in domestic deposits over the past 10 years, a 180% increase according to the Wall Street Journal analysis. Now, if we look at this, guys, we're looking at JP Morgan, Bank of America, Wells Fargo. So obviously, two banks that I'm buying have to do with these three banks. And so let's look at the data a little bit further. At the end of 2007, the three banks held 20% of the country's deposits. By the end of 2017, they held 32%. This is despite these banks being the reason that the economy failed in the first place. But let's move on. Because this doesn't really matter. What if they grew that much, but the rest of the banks, the regional banks, actually grew more? Well, I'm glad you asked, guys. So last year, about 45% of new checking accounts were opened at the three largest national banks, even though those lenders had only 24% of U.S. branches. Regional and community banks, by contrast, had 76% of branches, but only got 48% of new accounts. So it's not like they're growing, but they're not growing as fast as the regional and community banks that people might be flocking to. No, they're growing faster, they're growing better. And what's really interesting, guys, is let's look at this. Bank share in 2017, right? So 10% of deposits. JP Morgan over 10%, Wells Fargo over 10%. Let's look at them before 2007. Less. The point is, guys, what you're seeing is consumers going to these banks even though they shouldn't. So what is my point here? My point is, guys, that the reason I'm buying these banks is because of consumer ignorance. And I know that's very disrespectful to say, but it's consumer ignorance that I am investing in these banks for, because I think that most people don't really know what the heck they're doing with their money, so they just go to a brand name. As a matter of fact, if we look at online, oh, there we go, online mobile payments. So what they say in the Wall Street article is, before online and mobile banking became popular following the financial crisis, these consumers generally opened a new account at the branch with the nearest branch, no matter the size of the institution. But now that many banking transactions are done online or through smartphones, these customers are picking national banks because of their well-known brands and the perception that their technology is better. So two more things I want to point out from this article, guys, and then we're going to get into the individual stocks and talk more specifically about the individual stocks and why I chose them. So what we see, guys, large banks deposit growth is a major advantage because it provides the banks with an increased base of cheap financing. We'll get into that later, okay? That can be used to make loans. It allows them to avoid paying high interest rate depositors because most people are opening up checking accounts, which disappoints savers but boosts the firm's profit margin. So we'll get into that later, guys. The next thing, though, is the fact that JP Morgan and Bank of America they're planning to keep expanding by opening branches in U.S. cities where they have none. The three biggest banks, a couple of them don't have branches in certain major cities. Well, let's look at those cities, guys. So, for example, they announced plans to open in Denver, Indianapolis. Okay, those are major cities. JP Morgan hasn't named the 15 to 20 new markets it's entering, but it could include Boston, Washington, D.C., and Philly. Imagine you're a big bank and you don't have branches in Washington, D.C., Boston, or Philly. These are big cities that if you're not in, you're not capturing a lot of deposits. So, that's huge. Now, let's talk about specific stocks, guys. First thing we're going to do is look at Bank of America and JP Morgan together because they are essentially the same bank. They're national banks with arms in different kinds of banking, not just retail consumer banking. What I want to focus on in this video for all of these stocks is I'm going to be talking about the quality of deposits, the growth of deposits, and how the deposits are valued in terms of the share price. Because what a lot of people do is they try to look at the equity, the tangible equity to price, okay, which essentially means how much equity does the business have and what is the price you're paying for that equity. Now, the reason I don't use this is because deposits, the direction deposits are going, the cost of deposits, what is the structure of deposits are a lot more important, and what you're paying for the deposits is a lot more important because deposits are where wealth creation comes from. And so, guys, I'm very excited to get into this video today and share with you guys my valuation metrics that other people don't really use. So with that being said, let's start off with JP Morgan and Bank of America. All right, guys, so in terms of JP Morgan, I'm going to put up the numbers on your screen. They have a deposit to price ratio of 20.6%. So what this means, guys, is that when you're buying JP Morgan, you're only paying for 20% of the deposits when you pay for the stock. In other words, if we took the deposits, we divide by the number of shares outstanding, we get the deposits per share. Then if we take the share price and we divide that by the deposits per share, it comes out to 20%. So this is very good, guys, if you guys are asking. This essentially means that we're buying it for a very cheap price because usually bank stocks, they trade for a 30, 35, sometimes 40% of their deposits. Now, in terms of JP Morgan as well, we want to see cheap funding as we learned from the Wall Street Journal article. So we want to see that their deposits are a huge share of their liabilities. Now, in terms of JP Morgan, it's 64% of their liabilities. Now, this is a little bit low, but we have to remember that they're not just a consumer or a commercial bank or a retail bank. They're also an investment bank and they have other sides of their business. So this is an appropriate number given what kinds of businesses they are in. In terms of Bank of America, guys, we have a 17 deposit to price ratio. A 17% deposit to price, and their deposits to liabilities are 66%, which is fairly good. But now let's look at their ROAs, so the returns that they're getting for their assets, and let's compare that to their leverage. Now, just so you guys know, in this video, we're going to only be talking about tangible assets and tangible equity, meaning all of my numbers are factoring in tangibles only. And why this is important, if you guys are unaware, intangible assets, so things like goodwill, are not actual producing assets. They're essentially brand names. So for example, let's say that you have Pepsi and then you have some random soda company and they're the same exact product. You would have to pay a premium for the Pepsi company because of the logo, the brand recognition. This is known as goodwill. It goes under an intangible asset. So intangibles are pretty much the same thing as saying you overpaid for a company. In other words, it's not a real asset, okay? So we're going to subtract those so we can only see producing assets, and we're going to subtract intangibles from equity as well. Now, given that, the ROA of JP Morgan is 1.37%, which is fairly good given this interest rate environment. Bank of America, on the other hand, it's only 1.16. However, they're both levered up a good amount. Bank of America is at 12.2 times leverage, and then JP Morgan is at 12.42 times. And so therefore, when you lever up that much with that ROA, The ROE of Bank of America is 14.13%, and then JP Morgan's at 17.03. Now, Bank of America is doing a good job with their return on equities, a decent job, nothing amazing with their ROA. JP Morgan, on the other hand, doing a great job with their ROA given the interest rate environment, and a great job with their ROE as well. What we usually want to see, though, is a slightly higher ROA from Bank of America, but it's fine given their leverage. Their leverage is healthy at a 12, right? It's a little bit on the riskier side, but when I say risky, I mean a healthy risky, right? They're taking a little bit more leverage to get some better returns, but they're not going overboard. They have the capital and they have a safe leverage to be able to withstand the Rona. And they're still earning positive net income during this time, okay? Now, what else can we talk about, guys? Their PE, let's talk about PE. Bank of America's at a 12.45, at least at the time of this recording, and then JP Morgan's at a 13.44 PE. So I'm perfectly fine with those PE ratios. They're very healthy. I'm perfectly fine with all the other metrics. But now, guys, let's talk about one more thing, and that's deposit growth. Because as I've mentioned, guys, deposits are the cheapest source of funding, and that's where the loans come from. So we want to make sure there is growth because that's where revenue comes from. That's where safety comes from. Now, in terms of Bank of America, we've seen 19% growth over the past 5 years in terms of deposits. JP Morgan, we've seen 22% growth. But over the past 1 year, this is very important. Over the past 1 year, a lot more people have been putting their money into savings accounts. Because of this, over the past 1 year, year over year, guys, Bank of America has increased their deposits by 25%, and JP Morgan has increased their deposits by 27%. Now, why is this good? There's two reasons why this is good. Number one, it's a low cost of funding. And number two, guys, the deposits are going into savings and time accounts. Now, I know what some people are going to say. BK, this isn't good because saving and time deposit accounts are actually higher interest rates, and therefore the bank can't make as much money on those accounts. However, if they went into demand deposits like checking accounts, those have no interest rate, and so therefore it would be better if the money went into those because the bank would make more money on demand deposits and not saving and time deposits. And you are 100% right. In normal circumstances, that would be true. I'm giving an exception in this case, and here is why. When the Rona hit, all of these deposit rates have gone up because people have nowhere else for their money. They don't want to spend money, they want to save it, and this, that, and the other. Now, if people put their money in demand deposits, I'm projecting that what would happen is once the economy returned to normal in the next 1, 2, 3 years, people would actually take their money out and start spending it again like they did normally, and the deposits would shrink. However, since JP Morgan and Bank of America have increased disproportionately in the savings department of their deposits, okay, what's going to most likely happen is people are going to keep their money in for longer periods of time because that's what a savings account is for. It's for longer duration savings, okay? And then time deposits, well, if they're in a CD, they have to hold for a certain amount of time based on the contract. So maybe a 1-year CD or a 5-year CD, whatever it might be, they have to keep their money in there. And that's what I love about the growth in the time and savings deposits. Now, what I do want to say is overall, before the Rona, JP Morgan and Bank of America did not have nearly enough money in demand deposits. However, given how low the interest rates are, I'm not too concerned. I'm willing to take a slight risk with this. So it's not that big of a deal. I also want to point out that the shares outstanding for both JP Morgan and Bank of America have been steadily declining, and that's great for shareholder value. Now let's go talk about their dividends really quickly before we move on to Cullen Frost. Alright guys, so right now in terms of the dividends, JP Morgan 3.7% dividend yield. We also see a payout ratio of 64%. What I do want to mention here is that the payout ratio is probably shown as higher than it really is because since we're in the Rona, profits have gone down a little bit in the past 2 quarters. So in reality, this payout ratio is probably closer to maybe 55 or 50%. And so I'm comfortable with a 55-50% payout ratio and a 3.7% starting yield. A 5-year growth rate of 16%, but that's probably not sustainable for the long term. Bank of America, 2.88 forward yield, which is perfectly fine with me as well. 46% payout ratio, so we're going to see more growth ability in the payout ratio. And once again, guys, the earnings are a little bit low because of the Rona. So if the earnings were normal, the payout ratio would be lower, which is good because that means there's more room to grow that dividend. 40% 5-year CAGR of the dividend. Of course, that isn't sustainable, but we all know that, so that's nothing special here. So guys, to wrap up about the 2 big banks before we move on to Cullen Frost, I do want to say today. Go subscribe to my YouTube channel. Go right down below. Hit the thumbs up button if you enjoy the content so far. And now let's summarize my feelings on JP Morgan and Bank of America before we go on to Cullen Frost. So guys, JP Morgan and Bank of America, they're growing their deposits fairly well. They're growing in market share. They're becoming bigger and bigger. The number of banks in the United States are going down, which is great because it means more market share. Big banks can buy out small banks, get their deposits, and make them more efficient, and then they can put that onto their balance sheet and get better loans. So there's a lot going on for Bank of America, a lot going on for JP Morgan. I don't see these companies going out of business anytime soon. That, along with the fact that they have good management teams, good cash positions, and they're expanding into new markets, I just see a good boom here coming for the banking sector. So guys, with that being said, let's move on to Cullen Frost. Cullen Frost is a bank based out of San Antonio. Now, Texas is a booming economy, good GDP growth, faster than most other states in the entire union, great booming population growth. The cities that operates in are booming. San Antonio, we have Houston, we have Dallas, we have Fort Worth, and that's great. And then we have some smaller cities as well. On top of that, guys, the deposits are very strong and healthy. And so let's get into some of that numbers, okay? They have a deposit to price percentage of 16.71%. And guys, remember, when I'm bringing you guys all of these deposit to price ratios, these are pre-Roni Rona. So actually, once the deposits boosted year over year because of the Roni Rona, all of Bank of America, JP Morgan, and Cullen Frost are actually cheaper than this suggests. That being said, their deposits as a percentage of liabilities is 92%. So that's a 92% of cheap funding, and a lot of those deposits are in demand deposits and not in time and savings deposits, which is good because they're cheaper. In terms of the 92% deposit to liabilities, the reason this is higher for Cullen Frost is because they're more of a retail and commercial bank, and they perform much less in the investment banking space and in other spaces like that. So it's not a red flag for Bank of America or JP Morgan to have lower deposit to liability ratios because Cullen Frost is more specialized in the retail bank and commercial banking segment. In terms of their leverage and their ROA and ROE, their ROA is very strong with these guys at 1.32%. So almost like JP Morgan, okay, very similar in terms of their ROA. Now they're not levered as much. They're only levered 10.26 times, which gives them an ROE of 11.25. It's an okay ROE. It's a good ROA. The leverage is low though, which gives them potential to lever up a little bit more in the future when the economy starts coming back. So I see good, bright futures for this company ahead. Now, in terms of their PE, guys, they're a 13.32 PE, which is fairly consistent with JP Morgan and Bank of America. So nothing special about the PE, but because they're levered a little bit lower than all the other banks, once they lever up to that 12x like JP Morgan and Bank of America, they'll actually be getting similar returns on equity like JP Morgan if they levered up as much as JP Morgan. So that's why I love this bank so much. In terms of deposit change over the past 5 years, guys, their deposits have climbed by 14%. Not as much as JP Morgan or Bank of America, but these guys are selling for a discount compared to them, and their deposit mixture is a lot better. So we're going to get into that in a second. In the past 1 year, Cullen Frost has increased their deposits by 26%, so in line with Bank of America and JP Morgan. Now I'm going to show you their deposits right now, guys. Of the vast majority of their deposits are in demand deposits, which are low interest rate, as I mentioned before. That, along with Texas booming economy, population growth, and the fact that, guys, they're a very well managed bank, they have pretty good returns, and they're not levered to their full potential, gives me hope for this bank. Speaking of their management team, let's look at this, okay? So we have a 4% dividend yield over that actually for Cullen Frost, payout ratio of 76, which is kind of high, but again, we have to remember that their profits are down because of the Roni Rona. 5-year growth rate of a healthy 6.64% and 27 years of dividend growth. So these guys have gone through numerous recessions. When the Texas crash happened in like the 1980s because of real estate in Texas, they were fine, they survived. So their management team has been strong, has been great at mitigating risk for the past few decades. Bank of America hasn't really proven that they can go through every single recession. I think their management team has learned from the 2008 crash, absolutely, but these guys have gone through multiple crashes. JP Morgan has proven themselves through almost every recession that I've seen, at least in my lifetime. They were fine during 2000s, they were fine during the 2008, 2009, and they're doing fine right now. So JP Morgan has proven itself, Bank of America is starting to prove itself, and Cullen Frost Bank, it has already proven itself for decades, 27 years of great growth and a 4% dividend yield. yield. So I'm very excited, very happy about these banks. So guys, I'm very thankful you watched this video. If you did enjoy this video, smash the thumbs up button down below. Hit the subscribe button with the notification bell for a ring-a-ding-ding. Make sure you catch me for my next video because my videos are on stocks, and I always try to talk about stocks that are unique that other folks haven't talked about so I can offer you guys as much value as humanly possible. I'm a small channel trying to grow. So guys, with that being said, I hope to see you next time.